Hi everyone, welcome back. We're live here with Ryan today, and obviously it's very interesting what's happening in the market. We've seen a big spike in the morning with the NVIDIA earnings from yesterday, and now we are under a turning point in the market. So I think what's going to be interesting, Ryan, is to get your perspective and go through like a full playbook on how to analyze the data, the volatility, the options, the term structure to potentially structure trade ideas, especially for option plays.
Yes, absolutely. I mean, it's really a testament right now. Welcome back, everyone, to Volatility Corner again. I'm Ryan Darnell. We're in a really interesting market environment right now. I've never seen anything like this in my career, where one stock is driving so much here. I mean, and obviously there's concern right now across markets, but when we look at NVIDIA here, we kind of noticed that 5 days ago there was virtually no volatility, but this big spike priced in around earnings. And then we go look at the Qs isn't quite as surprising, but we see almost the same thing. This big spike in volatility, and then around the S&P, which should be theoretically more diversified, but no, we see this huge spike in short-term volatility. And it all seems to be, related to NVIDIA earnings. And at the end of the day, this AI story is driving so much of the economy, so much of our not just economics growth. The last estimate, or I heard one economist estimating that currently something like 92% of GDP growth was driven by AI. And for those who aren't familiar with that story, what they're saying by that is not that the AI itself is causing growth, but the investment in data centers, the hiring to build out those data centers, and leasing of things, the buying of components and parts and inputs for those data centers. And that's what's driving so much GDP growth. So right now, in many ways, the entire US economy, and some would argue even the global economy, for those who are familiar with the old story that when the US catches a sniffle, the world gets pneumonia. So, a lot of this story is really being driven by AI right now. And so I think, normally I'll start with the major indices that we always like to talk about, but then I'm going to pretty quickly get to to NVIDIA and how we, play and position around that ahead of earnings and in the coming weeks. So, the first thing I want to show you is that, just overall volatility. I always like to just start wide and zoom in. So when we look at the entire term structure of volatility, we've definitely had a nice boost. So I've consistently told our listeners here, once you get down below that 15% volatility level, that 12%, kind of 10%, you want to be leaning towards the buy side. Don't be short volatility. Don't be short volatility, especially not short longer term options, short Vega. And hopefully you were listening to that, and hopefully you either long options or relatively neutral, because now we're getting to the point where you can justify selling options again, or ramping up your risk. The other way to do it is not that you ever stop your strategy, but maybe you start de-risking. Maybe you buy, if you're used to selling 0DTE puts as an example, then you try to buy an out of the money put to protect that, to turn it into a put spread and de-risk a little bit. That's a way of reducing your exposure to volatility. It gives up some upside, but it also significantly limits your downside. So that would be one way you could do it. Another way you could do it is you could just sell fewer puts, or you can actually change your strategy. Those of you who have visited a few times, or who have visited the show regularly, have heard me say, there's famous sayings like bulls make money, bears make money, and hogs get slaughtered. So there's this idea that most traders tend to have a bias one way or the other. It's very hard to try to go back and forth and always be going the right direction with the market. But that being said, the best traders that I know do have the ability. They're not one-armed traders. They They have the ability to pivot and realize if their traditional strategies aren't working. So we want to, try to be flexible. And if our strategy is an option selling strategy, we want to know when to reduce risk and when to scale it up. Well, now's the time that you can start to scale it up again. The risk premium is coming back into the market. There's some real volatility there. You can actually make you're getting compensated for the risk. It doesn't mean the market won't be volatile and you won't lose money, but at least you're getting compensated for that risk now. We've talked about in the past, you want to sell umbrellas when it's raining, not when it's sunny out. And this is, I would say that this certainly looks like a light drizzle. So, you're seeing decent volatility here in the market, especially for short-term options. There's going to be real volatility, I'm sure, around earnings, but you are getting compensated for that if that's your style. And even if you go a little further out, the volatility is still decent. You can still pick up high teens volatility, even out fairly long term. You can even look to sell some, 60-day type stuff and still get a pretty high volatility level for the S&P. Real quick look at, and you're going to see these things are all going across Qs, NVIDIA, and S&P. The put skew is getting really bid right now. So puts are significantly more expensive than they have been. Significantly more expensive. So what this shows you is the implied volatility that's being used in pricing lower strike options. And so you can see this green line is just telling us that the puts are more expensive. To be fair, all options are more expensive, but it's particularly driven by the puts and fear. Right now we have some real fear back in the markets, which we haven't seen in a while, really not since Liberation Day. And then here you go, we can see this again, right? So this is another way to see the same thing I was just describing. Is the market bullish, bearish? What's the bias? Well, you can see here we were pretty neutral. Market got fairly bearish back in October for a second, but that very quickly was replaced. The bull euphoria, the bulls ruled the day for a while, with calls being way more expensive, relatively speaking, of course, to puts. But that fear is coming back. You can really see this slow, steady march really starting about a week and a half ago. People started getting concerned about markets, and I would expect that to continue for some time. But we are going to talk a little bit about strategies you can use to take advantage of that next.
And can I ask you a question to go?
Absolutely.
Because I think one thing that is important, Ryan, is also understand how fund managers think and how they are rewarded, right? So let's think about that. We are approaching Thanksgiving and the market has been rallying for the past kind of like few months, right? So if you are like a fund manager, you're not going to get a chance to lose profits, and you're also not going to take crazy bets in the last month of the year, right? So sometimes during this period, we see the market going kind of very short, turning back because people are kind of like scared of losing the profit that they did. So they're maybe adding more protection. How do you see that, and how was your experience when you were kind of like working for a fund?
Oh yeah, that's absolutely right. There's no question that is a real issue on Wall Street. So I distinctly remember in my days on the trading desk, as you'd get into November and then December, the word would start to go out. Okay, earnings, they're getting ready to report earnings. They're kind of finalizing earnings. Start to dial back your risk-taking efforts. If you can, tighten up. If you can, protect it. And at some point, they tell you, hey, bonuses are already set. Bonuses were already set, a month ago. So, you're not going to get paid for making money now. There's no upside. And so that was a big issue. And, sometimes there'd be some really good, really profitable opportunities that we would pass up on because no one was getting paid. No one was getting compensated to take advantage of those. And so I do think sometimes markets can get really wacky at the end of November and into December. And it's exactly what you just said, Fabio. They, fundamentally, people start looking to next year. They want to be able to report their earnings. They want to be able to report their final returns. They're looking at it and saying, hey, this was a pretty good year. We don't want to mess it up. Don't screw it up. This is a good enough year. And that can be really short-sighted because, of course, what if the market itself has a big rally in December and you miss out on that? But in practice, because so many people sit out or de-risk, they don't necessarily sit out, but maybe they're looking to buy some extra protection. They're saying, hey, I don't mind paying away a little bit of premium. So it's a real phenomenon. I think it's hard to, any of these seasonal phenomenons, also there's historical sell in May and go away. All these seasonal phenomenons, you have to be really careful about trying to predict market direction. But I absolutely think, though, that you can think of them as inflection points. It's kind of like how we talk about gamma levels, like resistance levels. It doesn't mean the market won't get above it, but it means that it's kind of a decision point for the market. Like if the market breaks through a key resistance level, it has the ability to run a lot further because a lot of people were counting on that level. And there was a lot of kind of short gamma at that, or long gamma, whichever at that position. And so, it's the same thing with these seasonals. So I think because volatility was too cheap, this turns the holiday period and the end of the year into a natural kind of change, jumping off point for changing your positioning. So if you're looking at the cost of buying downside protection, it's way easier to do that when volatility was, what did we just talk about? It was 12%. So if you're a fund manager and you go, hey, wait a minute, I can buy 40 days of protection. I can get through the year end, at 13% volatility. Why not? And if you could have bought 60-day volatility and protected your book pretty significantly, and then if volatility went up like it did, you could sell out of some of that protection and take a win, or hold it and still figure that you'll have another chance to sell it later in the year. So that's the thing. I mentioned this before. Option selling and option buying, you really have to consider those two positions differently. When you sell options, a lot of folks just, sell and hope for the best. I meet a lot of retail traders, and that's their intro to options is they sell options, they get used to collecting premium. They love it. It feels good. You sell options, they don't get exercised. You get the premium. Hey, that's nice. So you just keep doing it and hoping you don't get hit. And occasionally you do. But you try to kind of just weather out the storm. Buying options is a little different though. You don't necessarily want to just sit there and hope you get exercised. You want to do a little bit of delta hedging to recoup some of your premium. You want to actually think about buying longer dated options that'll hold their value so that if you're right and volatility goes up, you can sell them with some time value left. So you have to have a very different mental approach when we talk about buying options. And we're going to talk about how you can utilize that in just a second here. And, there's a great question, Fabio. And a reminder, anybody on there who has questions, please, by all means, throw those questions in the comments. Even if we don't have time to get to them today, there's a particular trade you want us to analyze, you can always put it in there, or you can email us and we will evaluate it and try to spend some time on it in the next volatility quarter.
And I think I have a couple of others because those charts are very powerful, right? But so if we go back to the beginning, if somebody's starting with option, the first thing they teach you in the playbooks is buy option when volatility is cheap and sell option when volatility is expensive, right? But in practice, how can users actually actionably use the data that we provide to potentially find those kind of ideas and obviously structure them trade? Because the biggest mistake people make is even going through earnings, you buy calls on Nvidia hoping that Nvidia is gonna make 3-4%, and even if it does, you probably lose money because you didn't really price volatility incorrectly, right?
Yes, absolutely. And that there's nothing more frustrating than doing something like that, right? So I will talk through, let's jump to Nvidia now and talk through a potential strategy for that. So when we see that Nvidia volatility is really high, if you just buy, let's say that you've been a big believer in Nvidia, you've been buying tech stocks for years now, but you're starting to get really nervous about Nvidia. And you're thinking to yourself, how do I protect myself ahead of this earnings? I'm not comfortable with my long Nvidia position. I want to do something. So this is a little bit of the opposite because I'm not saying to sell options, but this is a simple option buying strategy that you could do. you can see how much money we can save basically by doing this. So obviously, if you buy a kind of 1, 2, 3 day option, you're looking at paying 100% volatility. So even if your volatility, even if your volatility level is, or your realized volatility is good, it could rally significantly, but you may not make it to 100% annualized volatility. So one of the things that I would start to say is, where can I find some cheaper volatility to protect myself if I do a trade? And that's actually the thing that stands out to me. You don't have to go out very far for volatility to come down significantly on NVIDIA, right? If you jump out a mere 60 days, volatility is less than half of its current levels, less than half. So, so that'd be the first thing that I'd look at. And then the second thing that I would look at is the skew, the put skew. So, or call skew, as it were. So look at how much of that volatility is meant to cover against a major downside move. We've talked about this before, but when you have a market where people are typically long, like the equity market, people are worried about a sell-off. And so naturally, that's what they pay a premium for. And so personally, if I was really nervous about NVIDIA, something I would consider right now, you don't want to be buying these puts. It's just, you're going to be paying so much for them. Volatility's up. The put skew is up. We'll check that again. You can see that another way. Oh, this actually, the put skew is not as bad as it's been. But I think that's frankly because vol is up everywhere. Kind of depends what days we look at. But, it's sort of middle of the range. But regardless of, how you slice it, this put is very expensive. I mean, if you buy really cheap puts, you're looking at, 200% vol, or really low strike puts. So, where I would start here is saying, where's the cheapest vol on the curve? It's, 60 days out and slightly out of the money calls. So personally, if I was trying to figure out how to play NVIDIA, if I was long, I would be looking to lighten up my position and then buy calls. I'd be looking to lighten up my position and then buy some longer dated call options. And that might not seem intuitive, but that's exactly the way that you can use options to play the flat price. So the basic idea is, a call option gives you the right to re-own it, right? So you buy a call option, you'll still be in the market if we rally big, but you don't have to live with any of the downside volatility that's being priced at 100%, 200%. Now you're going to pay a premium for that without a doubt, but that would be the most basic trade right there, is sell some NVIDIA stock if you're long, or you could even sell a little bit against your call options, and then buy it out of the money call. Again, we want to focus further out here. We want to go to the term structure, and we want to see where it's cheapest. It looks like our downside out here at 60 days is not that much. Yeah, 50% vol sounds really high, but even a month ago, it's never really gone below 45%. So your actual downside risk to being long volatility, that particular type of volatility is pretty low. And so that's the key to understand here. You can't say in a vacuum, is vol high or vol low? You have to say, where has vol been? Where could it go? And so personally, if I was real nervous about earnings and what's going on, I would say that's pretty cheap. Maybe I'm risking volatility falls 5, 10%, but I get to significantly de-risk my position and own and keep my upside, or most of my upside. That's a great way to go. Let's say again, though, that you're one of the folks who really doesn't like paying a lot of premium. You're not quite comfortable with delta hedging. You're not quite you're just not quite comfortable with shelling out that much premium. Another thing you could do is, you could sell some short dated puts and use it to finance those calls, right? So you could go look at, so we call this a combo or a risk reversal. So you could look at, you could see how expensive the put skew is, and you could figure out which put you could sell to pay for that call. And what I'm guessing is that what you would find is, and I haven't priced one of these up yet, but we can price one and look at how it would have performed on our next volatility corner. But what you could do here is you could be, you're basically just going to remove a chunk of the downside risk, right? So you can buy calls that give you the upside of NVIDIA. You can sell puts, but that put strike will be lower than the call strike that you're buying. So, if in the way to think of it is if NVIDIA is here, you get a re-own ownership up here, but you're out, down for a much more significant chunk. So like using an example, maybe you're able to buy, we're trading what, 180, let's see, where's our, if it's, if you're anchoring to 186.50, maybe you're able to buy a call $15 out of the money. Maybe you're able to buy a $200 call. And maybe you can finance that with a 140 put or a 150 put. If it's a short dated put, maybe you can, maybe it won't pay for itself right away, but you can do a chain of those. Like you can do a string of those. So you could sell a couple of daily or weekly puts, out of the money puts, and very quickly pay for that call option. And you'll still have your long if everything turns out good, market rallies a lot, and you'll get back into your NVIDIA position, but you just significantly reduced your downside risk. So that was a bit of a curveball right there, because we actually said, hey, we could buy options when volatility is high. But the key there is understanding that volatility is not just a single animal, right? Volatility tells us what the market thinks at different times and at different strikes. And in the stock market, usually it's telling us how expensive the downside risk is, how much people are afraid. And it's usually telling us over what time period they're afraid. And, what we're seeing for NVIDIA is that people are really nervous right now, but they're really not all that nervous as you go out 60 days. So this is really a very much a short-term earnings play that's driving the whole market. And as we discussed, you're seeing this in the Qs and SPX. So you could really take these strategies that I'm talking about and you could look at those. Obviously, you got to consider taxes and other things if you're going to unwind an open position. But again, if someone came to me and said, I'm really nervous about all these longs, I made a lot of money in the last year and I don't want to get, I don't want to give it all back. That's how I would start. That's how I would start, is looking to buy some long dated calls. And by I say long dated, more than 40 days. In the markets I trade, we usually look a year or two, but usually for the equity markets, we're talking 40 to 90 days where most retail investors are interested. So I'd be looking to buy some longer dated calls. And then the only question is, how do I help pay for those? We could just go long. That's not a terrible strategy. You could buy a call spread if you think that NVIDIA's upside is limited. So a vertical call spread, you buy a lower strike call and you sell a higher strike call. That would give you, some limited upside, but it would significantly cheapen your outlay of premium. One other quick note: what I really like doing about doing some of those call spreads, if you buy a call spread, you're not exactly long volatility, but what's nice is out of the money options decay more quickly than at the money options. So if the market is stuck and you're long a call spread, you should be able to buy back that short call that you sold relatively soon through the life of the option. So maybe you only have to get halfway. Just as an example, I think, we were hedging some corn with a book that I manage, and we had sold some $5 corn calls, which are, now way out of the money, corn at $4.60. And we sold those call options at 20 cents a bushel, and now they're worth 2 cents. And that's in about 6 months. We probably sold them with a year, and now they're at about 6 months left. But the reason that they declined so much is because they moved further away in probability space. What I mean by that is they became very low likelihood to be exercised. But the at the money options have almost completely held their value. Whereas the out of the money options lost 80-90% of their value, the at the money options are still worth 15, 20, 25 cents a bushel. And so, you know, we kind of started with a short there, and then we did what's called a roll down, right? So we sold a call spread, and bought back those shorts. I've mentioned to some of you before, you never want to be short teenies. You never want to be selling lottery tickets. You never want to be, so if you do a call spread where you buy an at the money call or close to the money call and sell an out, you want to be always monitoring that short call so that if it gets really, really cheap, just go ahead and buy it back, or roll it down, you know, but you want to make sure that you're compensated for that risk. That's the key, is always make sure you're compensated for risk if you're selling options. You know, so obviously when it comes to selling volatility, so this was a bit of a curveball because we talked about volatility is high, the risk premium is there for option sellers. And then I told you an option buying strategy around NVIDIA. So that's a little bit funny. I'm going to try to, you know, we'll go back to something a little bit more straightforward. But the reason I wanted to do that is I wanted to emphasize why these different charts are so important, why the smile is so important, why the term structure is so important, and why, you know, the 2D, the vol surface is so important. Because vol isn't always expensive or cheap uniformly. You know, I love this screener, the vol model. I love, this is my first place one-stop shop to find places where volatility is expensive. But, and here's the key, there's not just one volatility number. The fundamental weakness of a monitor like this is it has to pick one volatility. So it's probably picking a shorter at the money volatility, or maybe using VIX, or, you know, there's a variety of different ways that this can be measured. This is probably short dated at the money. Is this 30-day vol, Fabio? Do you recall?
I believe so. Yeah.
Yeah, I think it's 30-day. So this is one very specific tenor, but that doesn't necessarily mean, you know, that all vol is expensive. That being said, this is still my go-to because it still is the quickest way to see generally if vol is expensive or vol is cheap. So, you know, I would go back to, but when you're selling options, you know, it's really best if you have a view. You know, like I'm selling puts because, you know, I'm generally bullish, or I just want to be generally positioned along the market, or, you know, I'm selling calls because, you know, I don't think it has that much upside, or because I'm long and I'm kind of seeing it as a covered call. So it's usually best if you have a view, unless you're an experienced delta hedger and you have the ability to manage your risk around that. Or I'd really say be selling options as spreads, sell put spreads, sell call spreads to minimize your risk. So, you know, in terms of if I want to just sell options, I mean, again, as I said, you could pretty much sell, not the ones that we just said were cheap, of course, but besides that, you can't really go wrong selling options at the moment. On QQQ, on NVIDIA, any shorter dated options are going to be a win. You know, we said even the calls weren't exactly cheap. The puts were expensive, but the calls were actually just as, almost just as expensive in relative terms. So I'd say you can't really go wrong if you're an option seller. You know, now's the time to earn your risk premiums. You know, there's a couple different ways you can do it. If you don't have a view, you can, and you aren't comfortable with gamma hedging, you can also look at selling strangles or iron condors. So you sell the straddle, buy the strangle, or sell a strangle and then buy a wider strangle. That's another excellent way to, to make a play on it without having a strong directional view. I haven't priced one of those up, but anytime you get 100% volatility, it's very difficult to lose. It's very difficult to lose on, if you have a directionless bet, meaning, you're just betting on the absolute level of volatility. It's just difficult for markets to sustain that kind of volatility. With the one caveat that if you're doing really short dated, you do need to typically repeat those strategies. So, again, that would be my advice for people thinking about how to deal with this. You really got to, when we get to these big moments in markets, like, NVIDIA's earnings coming up, which again, this now drives the entire market, S&P, Qs, everything. When you get to these big moments, you've got to, you got to kind of get back to your core, get back to what you're good at. I don't know how many people here are, sports fans, but you often will hear that, basketball, soccer, football, like a team has to get back to their identity. You have to figure out like what your identity is and what you're good. If that's being physical and playing defense, or if that's, shooting the 3-pointer, you gotta figure out what you're good at, and you gotta get back to your identity. I'd say for these kind of big stressful periods in markets, same thing. If you're an option seller, lean into your identity, because there's going to be some volatility. Manage your risk, do the spreads, maybe look to re-own a little bit of volatility to protect yourself on the cheaper parts of the curve. But again, the cheaper parts of the curve. But lean into it, because you are getting paid a risk premium right now. Whereas if if you're kind of new to this, but you're nervous and you're scared, and your typical strategy is just to be along the market, maybe now's the time to dip in a little bit and look to buy a little of the cheaper protection and lighten up. And if you were thinking of lightening up anyways, and that feels like the right thing to do, you can go ahead with that. And there's some sort of way between buying call spreads or selling some puts and buying calls that you can protect yourself from, being, from completely missing out if the rally resumes. So that's kind of my, my overall philosophy here is, when things are stressful, it's not a good time to change or do things different from what you're used to. If you're comfortable with options trading, buying, selling options, that's the opportunity right now is selling short dated puts and at the money options, buying longer dated out of the money calls, is definitely the play here. But if you're not familiar with either of those, you gotta lean into what you do well. With the one caveat that if you're a big option buyer, just as I was telling folks, if we go back to SPX, if you're always an option buyer for the broader market, not just NVIDIA, I would be hesitant now about buying options. 18% for S&P. It's not quite bad territory, but it's getting into dangerous territory, I would say. Or I'd say if below 15% is the level where, I start to get caught, I don't want to be short options. I want to be net long optionality. 15 to 20% is a little bit no man's land. And once you get above 20%, it really starts to become a sale. So these above 18, that's getting closer to sale territory for me, from an options perspective. I certainly don't want to be long a lot of volatility at 18. And, I'd be pretty comfortable being a little bit shorted if I had to pick a direction, because it's just difficult for the stock market to maintain volatility over a long time period. So if you're a consistent option buyer, I would start to de-risk, same as I was telling you to, if you got this perfect and you were comfortable trading long dated options, I'll tell you what a professional option trader would have done is back at 12%, we would have bought some straddles or strangles and delta hedged them over the last couple of months. And then when volatility rallied, say 5 vols, then we would be taking profits and we'd be selling those straddles back into the market. And hopefully the appreciation in Vega, or the amount of money we make on our options from implied volatility going up, is enough to offset any money that we lost in Theta. So that's the amount of premium that value that declined in those options that we bought. But remember, we were on gamma in the meantime, so we've been delta hedging a little bit. So we've been making some money on hedging those options. And for those of you who don't quite understand what that means, that's okay. But those are the kind of things that we want to try to continue to learn about and understand better. Okay, so now let's go back to the to my favorite and kind of figure out what some trades are. We talked a lot about the broader market and NVIDIA, but let's see where there might be, if there's any other little opportunities. I've talked about gold a decent amount on this volatility corner in the past, and I think we might be getting back to an opportunity in gold. Let me pull up our vol models. So when I look for what's expensive, surprise, surprise, SPX and QQQ are driving the bus right now. Those are the sales. So again, that's kind of what we talked about. If you want to sell vol, this would tell you that this is the most expensive vol that's out there, with the big caveat that that NVIDIA drives so much of this nowadays that it is effectively an earnings bet around NVIDIA and the AI story in general. So you are taking a view on that. There's not really a way around that. But there are a few other things that I think are pretty promising in here, and gold is one of them. It's not at a crazy level, but it's gone back into a positive risk premium. And I want to show you why. Gold was really funny. Gold has been a sleepy market for a long time with very low volatilities. Let's go back to...
And I think, Ryan, I don't know if you remember when we were doing this session maybe a month ago, the same chart, the volatility cross-asset monitor, gold was at the 100th percentile.
Yes.
And now it's gone down to kind of like 30-ish percentile, so which is kind of interesting.
Well, yeah, it's done the full thing. Look, it's gone a full round trip. So a lot's happened, and this shows why the volatility risk premium is a great starting screener, but it does simplify things a little bit, and so you really got to dig deeper. So we first started talking about this, and I first, probably back in September, October, was telling people, shoot, for my fund, I'm thinking about, selling some gold volatility. Like, this seems crazy. We never quite did anything because gold volatility still wasn't that high. It was kind of priced around 16%. And what happened here was not that that implied volatility came down, because typically what we'd say is when the volatility premium is high, sell vol. When the volatility premium is low, buy vol. That would have gotten you in a lot of trouble here. Unfortunately, I think having some veteran experience allowed me to avoid that, because what actually happened was the absolute volatility level of gold just wasn't that high. It was at 16%. So I kind of did nothing, and I've been watching it. And then gold got really volatile. So what changed wasn't the implied vol, it was the realized vol. Gold got really, really, really volatile over the previous couple of months. And then slowly implied volatility started to creep up from these 15, 16% levels up into the 20s. And now gold is seeing a more permanent state of higher vol, just as, and what's interesting is that's happening just as price volatility is starting to come back to earth. So suddenly there's a real interesting opportunity here, and I'll show you exactly what I'm talking about. So this doesn't look great when you look at it, just in a vacuum, right? You're like, oh, 20%, I missed my best opportunity. If I'd have sold it exactly 1 month ago, vol was higher. And you can see short dated vol got really, really high, like 50%. But it was actually moving that much. It was actually realizing for a very brief time period. And this was the panic in the volatility market that was following that. So, but if we look at this same chart, so you'd probably look at this and think, volatility is not a sale here. But what's really interesting is when I roll back to September or October, like late September, when I first started talking about this idea, look where we were. We've been moving from 12% up to 16%. And so what we're seeing here, and so these charts are useful, but as a trader, I mean, there's so many powerful tools on MenthorQ, and it's really alluring. It's really enticing to think, okay, there's one screener that's the end all be all, but it's really important to understand that we have all these powerful tools and you have this historical data to go back and use it. Because I mean, this is, if I told you, hey, now you could sell volatility up here, like above the chart, you would go, heck yeah, sign me up, right? And so, so that's pretty interesting right there. That and what's especially interesting is it's not just the short end of the curve, but kind of the whole curve that's moved. Because I'll go back to the most recent one, but even the long dated volatility has seen kind of a permanent shift. We used to see that the volatility market was, okay, the market seemed to think somewhere between 14 and 16% is the right vol. And maybe short term it could spike more, but it was going to decline back towards that. But now when we go back to today, Even when the market spiked to 50, it was really pricing in a big regression back to below 25. But it seems to have settled into a really flat curve structure, meaning that they seem to think that volatility in gold is permanently higher now. Maybe permanently is the wrong word, but for at least the medium term. And what's interesting about that is prices go up, usually volatility declines in commodities. You can kind of look at the history of that. Not always. It certainly depends on which commodity you're talking about, and you'd have to do some historical analysis. But to me, this is really enticing. So I've been keeping an eye on the implied volatility monitor here. I've been keeping an eye on this volatility risk premium, kind of waiting to see what would happen when realized volatility started to come back to earth. When realized volatility came back to earth, would implied volatility fall faster, or would it kind of stay at those elevated levels with a new risk premium? Because probably a lot of market makers, a lot of vol sellers probably got burned pretty bad on gold when realized volatility spiked. So is there an opportunity here? I think so. I'll be keeping an eye on it. I don't know that I'm ready to act quite yet, but personally, I think we could have a real opportunity here because we can sell long-term, fairly high vol levels for what is typical in gold, right as realized vol seems to be losing steam and the gold story sort of wearing itself out. And fundamentally, getting into fundamentals, I mentioned this when we did our interview on the last Volatility Corner. I do think that there's a fundamental issue where historically, if you look at GDP, if you look at the kind of global wealth portfolio allocation, if you will, if you look at how people have invested their money, there's always been an allocation in there for gold and what we might call, they call it a reserve asset or an asset of, like a safety asset. The reason people have held gold historically, gold returns have not lived up to stocks, not by a long shot. But the reason people like holding gold in their portfolio is because gold has had a slight negative correlation with the stock market. And in some particularly scary instances, it's had a very negative correlation. So what do I mean by that? When the stock market's really crashing, gold is really rallying. So it can really act as a portfolio buffer. You accept slightly lower long-term returns, but you significantly reduce your drawdowns in a bad year. And that's why, for those of you who are fans of like Ray Dalio or who are familiar with like the all-weather portfolio, that was a core concept of that idea, was to be long gold for exactly that reason. And, but now here's the big challenge to that. There was always kind of a cap on how much people wanted to hold gold because we just talked about the big weakness. It lowers your returns. Yes, it improves your return profile. For those of you who are familiar with leverage, you can theoretically use leverage to get your returns back up, but that's really getting into the weeds there. And most people at the end of the day, if they see the stock market going up 15, 20, 25% a year, they don't want to be missing out for gold. Now you bring in crypto. Crypto told a lot of the same story as gold, right? A lot of the same concept. The government's going to print too much money. There's a risk of financial crises. And so I'm not being negative about gold or crypto here, but the thing that I want to emphasize is that, if historically, call it 6 or 7% of the global portfolio has been invested in gold, and now crypto is starting to grab a percentage of GDP, a percentage of kind of national wealth. What percentage is that? Is that taking from gold? Is that taking from stocks? Is that taking from bonds? And you really got to have an answer to that, because at the end of the day, either gold and crypto have to steal from one another, or they have to steal from another bucket to justify continued price rally. And I think you've seen that now with crypto backing off, is a lot of people are rediscovering gold, if you will. A lot of the gold bugs who kind of lost interest for a while with the crypto story are starting to see that, actually gold can be a pretty nice little negative hedge too, or, negative correlation hedge as well. And so, so there's really interesting phenomenon that we're dealing with right now is how these two are going to compete, or will they compete at all? Maybe they're just going to steal from bonds. But I'd be real cautious about that story that they're going to steal from bonds. And I'll tell you why. Because a lot of the bond ownership comes from people who don't have any control over it. Pension funds have to own bonds to meet a lot of their obligations. Insurance companies have to own bonds to meet their obligations. Banks have to own, treasuries to meet their obligations. You can go look at all the various regulatory capital requirements for banks, pension funds, and insurers. They all require bond holdings. So most of the bonds out there are not being held by your regular investor. They're being held by institutions who don't have a lot of flexibility. So I'd be real hesitant if somebody told me, oh, government bonds are trash. We're going to sell those and everyone's going to move their money into gold and crypto. If people haven't gotten out of bonds by now, after seeing interest rates go from 0 to 5%, and after the massive losses that bonds took, then I don't think they're going to be getting out of them. So you got to have a really interesting story for the next leg and for this battle that I see, the head-to-head battle between crypto and gold. And I think you're seeing that right now. Gold's been winning of late, but we'll have to see how long that continues. So that's why I think, but I do think they're going to each limit each other's growth going forward, which is why, again, I think there's an interesting opportunity with gold here. Still trying to figure out what the exact trade is, but you're looking at, gold volatility that really ramped up, but I think it's going to run out of steam just a little bit personally, just because, again, a lot of the people who would be buying it historically have shifted over to crypto. And so will it run out of steam? Plus, as we've talked about, markets just tend to burn themselves out with realized volatility. It's just difficult to maintain realized volatility that's so high over such a long period. With that, I just wanted to open it up, see if there's any more questions. Fabio, I don't know if you have any other questions, but those are kind of my big things to look out for. I'll watch the comments board here for another minute or two. But those are the big things to look out for. NVIDIA earnings driving the bus. We may not like it. Us graybeards like me, think, oh, this is, this market's out of control and NVIDIA is driving everything. But we have to respond. We have to deal with the way that markets are evolving. We have to understand that this is the story that's going to determine things. So we need to be positioning to protect for it. I guarantee you, as Fabio asked about, I guarantee going into year end, all the professionals are positioning around this. It could be their last big event that drives their P&L for the year. And, you need to consider it in your portfolio, because if you're a traditional S&P or certainly NASDAQ investor, you're highly exposed to 7 stocks. So if you are interested in ways to take protection, or if you're looking ways to add some additional risk or diversify that risk, volatility plays and options plays can be the way to do that.
Absolutely. I don't think I see any questions in the comment. I think the other big thing, Ryan, for Friday is a big OPEX. I think it's the last or probably the most important one for the year end. I know December gets kind of like less volatile typically, but understanding what's going to happen on Friday, how the market is going to reposition after OPEX, going to be very important.
Yeah, that's a good call. Although I think, I also think it's important that people understand around these numbers. In my experience, we would always joke. So we always had a fundamental analyst on our desk. His trades were always behind. And so I like to joke that, the fundamentals follow the market. I've seen this so many times in commodities markets where an analyst will say, oh, we have a big shortage of corn after corn prices have rallied like 50% or 100%. It's like, well, yeah, no kidding. Of course we have a shortage of corn. That's why the market already rallied. And so it's very easy with fundamentals to get stuck in the past. And so as a trader, what we try to do is worry. The way I've had success in prop trading for a fund and a bank, and for my own fund, is rather than worrying about what the news will be, because oftentimes that's already priced in, we worry about what's the risk if everyone's wrong. So if corn was really high because there was a big shortage, we'd ask ourselves, not is there a shortage? Of course there is. How could the shortage end? What would it take to end the shortage? Okay, it's a big planning number. Understood. Or I'll take a better example that's really clear. When we had big oversupplies of commodities, it was, okay, what could end that? Is there any buyer big enough to shift it? Okay, China. So we need China to come into the market. So then we started waiting and biding our time and constantly monitoring, Chinese imports for a sign. And we were able to time it and get long, both futures and volatility, around that time when the Chinese started to get more active, because we realized that that was the big thing when there was big oversupplies and prices were really low. It wasn't that prices needed to go up at the time; they didn't. It was that the risk was to the upside, is what we would say. Not that the market should go up, probably should continue to stay low or even go lower, but the risk is to the upside, and vice versa. When prices are high and supplies are low, we'd say the risk is to the downside. And right now, when I look at stocks, the risk is still very much to the downside. That being said, it's been to the downside now for about 10 years. So we know it can go for a really long time. So you always have to be watching for cracks, and what would cause that. But, if you're looking for a short-term bounce back, with a very short-term view, you might even be able to say risk is to the upside right now for tomorrow. It kind of depends if you're taking a macro view, like a 20-year view. If you look at like CAPE ratios, the cyclically adjusted price to earnings ratio, then you would definitely say risk is to the downside. If you're a fundamentals person, taking a 20, 50, or 100-year view, you say the risk is the downside for stocks. But if you're technical, I think we're getting close to, oversold. I'm not a big technical guy, but I'd be taking a look right now and I'd be thinking that there's a decent chance for a bounce back here. So, it all depends on what your time horizon is and how much risk you're taking. But, just a few things to be thinking of as we go into year end. But, with all these big reports, NVIDIA earnings, don't be surprised if NVIDIA earnings are good and yet we still go lower, or vice versa. They're bad and we turn around and bounce higher, because maybe a lot of this selling has been, in anticipation. The fact is, these things leak. There's plenty of economic research that shows that insiders trade, people get information, they trade in advance. So I wouldn't be shocked at all if, for example, NVIDIA disappointed significantly, and then the market turned and started rallying again, because this sell-off over the last, 3-4 days, week and a half, has been kind of baking that in. So you can't assume that certain. I mean, just take this morning, right? I thought when I woke up this morning, when I saw that labor, the labor report that hiring was up more than expected, I thought we'd have a big bounce day after all the red we've been seeing. But no, we started up and then turned bloody really quickly. So realize that. Don't try to trade what the news is doing. Try to understand where the risk lies. Like, where's the risk if people get disappointed or if things don't happen as people expect? That's what you really want to. So right now, it seems like people are starting to get really nervous. So I'd say, again, short-term focus, risk is probably to the upside. Longer-term focus, the stock market's been dealing with the downside risk for a long time. I think that chickens will come home to roost eventually, but it hasn't happened recently. I don't see the catalyst for that to happen in the next 2 months. So with that, thank you all for joining Volatility Corner. Unless you have any other questions, Fabio?
No, I think this is great. As we said, guys, so we're going to be back with Ryan in a couple of weeks. The goal of this session is really to bring the perspective of someone that has had the basically background of institutional trading. So basically, Ryan has been kind of trading for a fund, he's managing his own fund, and he's kind of working with us to kind of bridge the gap between the tools that we can access and the tools that institutions have access to. So we're going to have a lot of these sessions with Ryan. Next week, we are also going to have a very busy week. We're going to have some live trading. We're going to have some use cases. We'll trade live Tuesday and Wednesday, so stay tuned for that. And also, don't miss the Black Friday sales, guys. Scan the QR code here and get access to that. They will end next week. So Thank you, Ryan, and see you guys soon, and see you guys tomorrow and next week.
Thank you all.